incepted in 1992, and before that the controller of capital issues used to have a major control over the activities of the capital market. But after the inception of the Securities and Exchange Board of India, we have got a stringent rules and regulations are being there for each and every financial services that is being provided to the benefit of the domestic institutional investors, individual investors, foreign institutional investors as well. Now, insurance is also another part where you can be able to invest, because we have said there are different components, there are different avenues of investment, and for the purpose of insurance company, because a few days ago we have got only the life insurance corporation for the insurance of your life, we have got the general insurance corporation and national insurance corporation as well. But the life insurance corporation is still the leader in this insurance market. But with the increase in the population and demand for insurance, the private insurance companies are also given the permission. Private companies are also given the permission to do their insurance business. And to have a better control of the insurance companies, we have got the regulatory bodies like Insurance Regulatory Development Authority, IRDA. So, we have got 4 different regulators like the Ministry of Finance, the Securities Exchange Board of India, we have got the Reserve Bank of India, and finally, we have got the Insurance Regulatory Development Authority to have a major control over the financial system of India. Then we come to the another most important component of this financial system, without which we cannot be able to go for making any transactions or making any operation in the capital market. That has been termed as the financial institutions. Because after the 1992, when the Securities and Exchange Board of India were established, all kinds of transactions are to be made by check. And for the purpose of dealing with this, and all kinds of corporate dealings are generally being done through the check, issue of checks. So, for that purpose we have got the banking institutions are being there, and for the overall development of the Indian financial system, we have got certain non-banking financial institutions. They have been termed as the NBFC, non-banking financial companies or non-banking financial institutions as well. Mutual funds is another type of financial institution. I will take a brief note on the mutual funds when we are deal with the financial services. And we have got also the insurance and housing companies. Insurance companies I have discussed a little bit of the insurance companies in India. We have got the housing finance institutions are also been there. So, what if you make a classification or distinction between banking institution and non-banking institution, how you can be able to distinguish? Because in the case of the banking institution, what the benefits you can be able to have? First of all, you can be able to open an account, you can deposit your money, you can keep it in safe custody of the banks, it is very secured, you can be able to withdraw your money, and if you have surplus in the bank, you can be able to generate interest. But if in the case of the housing finance institution, which is also being termed as a financial institution, and the life insurance institution, what is that? The difference is that in that circumstances, you cannot be able to open an account there. But they also deal with the financial transaction. Like in the case of housing financial institution, if you want to take any loan from making your own house, you can go directly to the bank, but you can go the housing finance institutions as well. And I think you all know that different bank institutions have also opened up their home finance. But the basic difference is that, like in the case of HDFC, Housing Development Finance Corporation, in that case you cannot be able to open an account, you cannot be able to deposit your check or deposit your amount or keep it in safe custody, it is not been possible. So, the difference between a banking and non-banking financial institution is that in the case of banking institution, there is exclusively for the purpose of providing services to the depositors The word depositor is very much relevant to the financial institution or the banking institution. But the non-banking institution, they are being termed as the customers or the clients, because you are getting the services in terms of getting some loan, and the transaction is been that whenever a loan is being sanctioned to you, then your job is to go for repaying the loan as per the terms and agreement that has been made between you and the loan giving institution. So, all these banking institution, non-bank institution, mutual funds and insurance companies and housing finance companies come under the purview of that financial institution, without which we cannot be able to think about the financial system. Next we come to the, suppose what we have said, the banking institution. In the banking institution we can have some broad classification, like we have got the scheduled commercial banks. That means whatever the banks we are being saying, other than that, the other name is also termed as the nationalized banks. They are being nationalized because previously you have got the private banks are being there. Now then it is being nationalized or given the character or the emblem, they are the national banks. So that the most important thing is that generally national banks have huge amount of security and it is being supported by the government. So scheduled commercial banks can be categorized in the form of public sector banks like State Bank of India, Bank of Baroda, Canara Bank. All these banks coming under the purview of the nationalized banks or the public sector banks. We have got the private sector banks. There are number of private sector banks have come out, like the Axis banks have been there. Then we have got the HDFC bank is been there. Yes Bank is been there. There are number of banks, they are privately been operating their services, and some of the companies, for your understanding, for your knowledge, some of the companies are now giving their proposal to the Ministry of Finance to set up their own banks, and it has been kept pending in the hands of the Ministry of Finance to get the approval of a committee, that is the committee has been set. And we, after a few months of time, we can be able to find that some of the leading corporate entities have come out with the different banking institution. Then we have got the foreign banks, and there is a very good reputation of these foreign banks in providing different types of services to the customers. And if you make a visit to the village, you will find that the regional rural banks are being very much prominent, and there are lots of research works are being there. You will find that the rural people generally prefer these regional rural banks than the nationalized banks. So in that case, regional rural banks are also providing a very good services to the rural people. And we have also got these scheduled cooperative banks. Cooperative banks, you know, a group of people in the form of cooperative, they start their business for getting the deposit from the local people and channelizing the funds in the forms of loan. But the most important thing is that they have been registered. When they become registered, they have been termed as the scheduled cooperative banks. So these are the banking institutions are being there. I again go for this non-banking finance institution. Non-banking financial companies is a broad character or the broad name, they have been coming under this particular emblem. We have got a different development finance institutions are also being there, like in the case of the Small Industries Development Bank of India, like NABARD for the purpose of agricultural development, like we have got the IDBI, Industrial Development Bank of India. It is not the IDBI bank, but IDBI, which was exclusively for the purpose of promoting industry. We have got the Industrial Financial Corporation of India, and SIDBI is also being there. So these institutions, what I have said you repeatedly, the difference is that you cannot open an account and get the services of a depositor, but you can be able to get the financial assistance from these non-banking finance institutions. Now you come to the another investment avenues to the investors called mutual funds. Mutual fund is an institution which acts on the behalf of the like-minded people to accumulate the investment of those investors make a corpus that is called a fund, and that particular fund is again being redirected to the either in the security market in the name of either in the securities or debentures. Then whatever the in return that is being generated, it is again redirected to the investors. Mutual fund is formed under a trust of the Indian Trust Act of 1882. So mutual fund we have got, because in the chapter where the mutual funds are to be discussed, it is to be discussed in detail. But for the purpose of mutual fund, the leading mutual fund institution is the Unit Trust of India, which has been incepted in 1963, and the first mutual fund scheme, because there is a difference, because generally there is a misconception about the, because it is which is very common that I invest in the mutual fund, but it is not true. Because when you go for making an invest in the mutual fund, we invest in a scheme, because we have got the mutual fund institution that is called mutual fund, because it is based on trust, because the sponsors are being there, they sponsor certain a mutual fund trust, and that particular trust appoints some asset management company who acts on behalf of the investors to accumulate that money, and the custodian is being there, and they keep in safe custody whatever the shares and securities are being purchased, or debentures are being purchased, or money market instruments are being purchased, they keep in safe custody, and whatever the return that is being generated, that is again being redirected to the investors. So here what is happened, that risks are minimal. In the case of the directly putting your money in the stock market, what is happened, risk is absolutely yours. But when you put your money to the mutual fund schemes, as there are a number of unit holders, another information that you are likely to understand or keep it in mind, that when you put your money in the shares, you are being termed as the shareholders, and when you put your money in the mutual fund units, it will be termed as the unit holders. But the basic difference between shareholders and unit holders is that shareholders can claim ownership of the company, but the unit holders do not have any kinds of influence on any of the activities of the corporate entities. But in the case of the security of the shareholders, they have to go for getting the benefit either of the full profit, or if there is a loss, one has to suffer the entire loss. But when you put your money in the mutual fund, as there are a number of unit holders, so in that case the loss are to be distributed, so the quantum of loss is very less, as well as the profit when it is being making, it is to be also not at par with the quantum of profit which you can be able to get when you put your money in the shares. But the risks are being there, but from the investor's perspective, it is generally been prescribed that if you have lesser amount of risks to sustain, in that case it would be better, it has been advisable to put your money to the mutual funds. So as an student of this finance, you should have sufficient knowledge of the mutual fund, because there are different types of mutual fund schemes are also been there. With the broad category, they have been categorized under open-ended scheme and closed-ended scheme. And when you go for another version of the mutual fund, there are public sector mutual funds is there and private sector, like U2I is a public sector mutual fund. But when you go for the private sector mutual fund, that are also being common nowadays. We will discuss about this mutual fund in the later classes. Then we have got the financial market. What we have said, we have got the regulators, then we have got the financial institutions are being there. And when you have purchased some shares or securities, and if you do not have a place, common place, so that you can be able to go for making any change of hands of the securities, then it is never been possible for the purchaser to purchase shares or sellers to sell those shares. And for that purpose, we have got the financial market. And for your understanding, you know it very well, nowadays the share market is basically based on online transaction. The first thing you have to do, you have to open a demat account, because before 1992, it is needless to say that there is no question of making any demat account. But nowadays, it is very, very important to go for opening a demat account there. This is from the individual investor's point of view. The financial market categorized under two broad heads. One is called the capital market Another term of capital market is the long term market, and the money market is also been there, which is for short term duration. Okay. Next we come to the capital market. When you go for the capital market, we have got the equity market and debt market. In the case of the equities, which is, what is equity? That means when you go for putting your money in any company's investment, obviously you have got the individual right or ownership of that particular company. That is called equity. And in the equity market, we have got the primary market, we have got the secondary market, as well as we have got the derivative market as well. Primary market means that when a particular company, the new company goes for a public issue for the first time into the market, it is being done through the primary market. And with the passage of time, we have found that with the inception of the Securities and Exchange Board of India, the total primary market is also being done through this process called a book building process. It is also require a detailed discussion of the primary market, which is to be covered in the next classes. So, primary markets, in the case of the primary market, if a company which is a new company, keep it in mind that when a new company goes for public issue for the first time into the market, he has to come out with an process called IPO, initial public offering. And when an existing company wants to go for a collecting money from the public, it will also come out through a market, that is a primary market, and a process called FPO. It is called follow on public offer. So, primary market is been there. Then we have got secondary market, that when you invest your money in the primary market and collect some initial shares of the company, now when you go for making or selling it in the market, it is only been possible if there is a secondary market. And we have got a derivative market, which is of recent origin, which is a very, very critical one, and which requires lots of study for the understanding the derivative market. We have also got a debt market as well, comprising of the private corporate debt, public sector undertaking bond market, and government securities market. Because the equity market, which is very risky, debt market on the other hand is the quantum of risk is less, where you can be able to generate an amount of return which is generally been secure. Money market is another phenomena in the case of the capital market, in the capital market parlance, because we have in the financial market parlance in a broad sense, because we have the capital market and money market, where the money market is comprised of the treasury bill, called money market, commercial market, and certificate of deposit. These components are very, very common for the corporate entities, and the individual investors cannot participate in the money market parlance. And now come to the most important one, because if we just make a link up, what we have started, that the financial system is comprised of 5 different components. We have started with the regulators, then we come to the financial institution, then we have discussed in financial market, then financial instruments are being there, because without the financial instruments you cannot be able to deal with in the financial market. And if you do not have the services, which is very, very important nowadays, and after 1992 what we have found that the number of services are being enjoying by the corporate entities as well as by the individual investors. It starts with the merchant banking. It is totally a different proposition in respect to the traditional banking system. We have got the credit rating institutions are being there, factoring services are being there, leasing, hire purchase, portfolio management, underwriting, depository services, and custodian. In that circumstances, that if you do not have any understanding of these services, so in that circumstances you cannot be able to get the opportunity of utilizing those services. If I just make a few minutes what the financial services are comprised of, like in the case of merchant banking, it is also been termed as a non-traditional banking system, where suppose you want to go for a 500 crores of rupees for a bank loan to open up your own industry. So, if you put your money, put that particular proposal to any bank, they will redirect their merchant banking division. Merchant bank is not new to the public, those who are very much associated with this particular terminology, but it is very new to the person, most of the person, because the concept of merchant banking arises in 13th century in London. So, we are not discussing in detail, it will require more and more discussion in the latter classes. Credit rating means, because you are being very much familiar with the credit rating institution like Crystal Care, ICRA. So, if you want to invest in debentures or any other debt securities, there are certain institutions are being there which take up the responsibility of understanding the creditworthiness of that issuing company and just disseminating that knowledge and awareing the knowledge to the investors, that whether that investment in the securities or the debt are good enough so that they can be able to get their return as the terms and agreement that has been made between you and the issuing company. Factoring services is very common nowadays. It is for the purpose of recovering the debt on behalf of the client. Leasing and hire purchase is very common to the investors. If you want to purchase an LED TV, it costs 1 lakh of rupees, and suppose you do not have the requisite money to pay, but you have got some amount of money to make an initial investment, making the first installment, the rest of the amount can be able to be paid after the latter days if you can be able to go for contacting with the leasing agency, because that has been common phenomena nowadays. Portfolio management is also very common. If you have the money, but if you do not have the sufficient knowledge base, where to invest, how much to invest, when to invest, in that circumstances the portfolio managers are being there who can be able to provide these services. Underwriting is also common phenomena. We will discuss the other parts, other services in the next few classes. For your understanding, because the financial system, and if you take that capital market into consideration, the shares, because we have got the two leading stock exchanges are being there. One is called the BSE, Bombay Stock Exchange, another is called the NSE. And generally, if you go for the BSE, the performance of the stock market, it is generally been dependent on the sensitivity index of the performance of all the shares. And the BSE is generally being evaluated based on Sensex, SENSEX. It is called sensitivity index of 30 shares listed in the Bombay Stock Exchange. And another, I have, for your understanding, I have given you all the 30 shares, the latest one, because all the 30 shares, and you just keep it in mind, these are the shares that comprises of Sensex. There is another stock exchange which is also the leading stock exchanges nowadays, which is also made a late entry into the equity market in our India, that is called the National Stock Exchange. We have got the NAC, and the National Stock Exchange is the performance of the National Stock Exchange is being made. It is the sensitivity index of the 50 shares listed in the National Stock Exchange. And very recently we have got another stock exchange that is called MCX-SX, and it comprises of 40 shares. Please go through the shares which are being there part of this Sensex, Nifty and MCX-SX, so that you can have a better idea of the total financial system and more importantly Indian capital market. So, for the time being, I am just closing my discussion today. We will see you later. Okay, thank you very much.